This morning I paid $80 for an ounce of silver in New York. My contact in Shanghai just told me he paid $90. Same metal, same day. $10 difference. That's not a premium. That's not a spread. That's a funeral. Because in 48 hours on January 1st, that $10 gap becomes a canyon. And if you're holding dollars instead of metal, for years, silver has been treated like a cheap cousin of gold. Sparkly, sentimental, and supposedly abundant. But that story is cracking. Reports from industry groups indicate that since 2021, the world has been in a consistent supply deficit for physical silver. In simple words, more silver is being consumed than dug out of the ground or recovered through recycling. Demand is being pulled upward by giant industries. Solar energy. Once silver is used in a circuit or a solar panel or a battery component, it's not coming back into the market easily. It's locked in. Imagine pouring water into sand. The supply disappears and the need just keeps growing. That's what's happening right now with silver. Analysts estimate that global demand is now above 1.2 billion ounces per year. Supply hovers closer to 1.0 billion. That leaves an annual gap, roughly 200 to 300 million ounces, filled by inventories, stockpiles, and stored reserves. Vaults around the world have quietly been drawn down to fill that missing volume. The situation worked until it didn't, because once metal leaves a vault, it does not magically return. And 2025 was the year a lot of vault doors started looking empty. This brings us to China. It is not secret that China is one of the world's most critical hubs for silver refining and manufacturing. While they are not the largest miner, they are one of the largest processors. Raw silver from countries like Mexico, Peru, and others has often been refined in Chinese facilities before reaching the global market. This matters because the majority of silver demand growth is coming from industries in which China is heavily invested: solar panels, electric vehicles, advanced electronics, and semiconductor supply chains. If you control the refining and the transformation of raw metal into industrial-grade material, you control the timing of supply. You control the heartbeat of the market. In late 2025, China's Ministry of Commerce announced what appears to be a new export licensing system beginning January 1st, 2026. Multiple reports describe it as a framework where only certain companies can export silver. Conditions reportedly include large annual production volumes, strong financial backing, and government approval. This doesn't ban exports. It doesn't outlaw trade. But it changes the rules of the game. Instead of silver flowing freely out of the country, it may be routed, measured, or slowed by bureaucracy. For a global system that relies on speed, predictability, and continuous flow, even a slowdown can feel like a chokehold. Think of it like oxygen. You don't need the supply cut completely to feel pain. You just need someone to put a hand around your throat and tighten slightly. The world starts noticing. That's what the market reacted to. That's part of why the Shanghai physical price jumped ahead of New York. Price is information. Sometimes price is the most honest news source we have. Let's pause here. If prices rise too fast, why can't mining companies just open new mines? Because mining is not like turning on a tap. A new silver mine can take 7 to 10 years to plan, permit, finance, and construct. Even expanding an existing mine can take years. And here's the twist. Most silver is produced as a byproduct of mining other metals like lead, zinc, or copper. That means silver supply depends on the health and investment of industries that don't even care about silver. If copper demand falls, copper mines slow production, and silver supply falls with it. Silver cannot simply scale on command. Meanwhile, industrial buyers are not waiting. Rumors and early reports claim that companies in electronics and renewable energy have begun negotiating direct contracts with mining companies. Cutting out traders, cutting out refiners. We are seeing whispers of a new supply structure. Imagine a tech company driving directly to a mine and saying, "We want the next 10 years of your output. Name your price." For industrial giants, the metal is oxygen. They don't need cheap, they need certain. This is where the price disconnect becomes surreal. On futures markets, the paper markets, silver might show a price. On the physical market, the number is different. Sometimes a little, sometimes a lot. It's like listing a car online for $20,000, while a buyer at the dealership next door is begging to pay $30,000 just to drive home today. Which price is real? The screen or the sale? Markets are supposed to be rational, but systems under stress don't behave rationally. They behave urgently. Large financial institutions understand urgency. It's no conspiracy to say banks have influence in commodities markets. They always have. It's public record that JP Morgan paid nearly $1 billion in fines in 2020 related to metals trading misconduct. That's not speculation. That's documented, confirmed, and settled. Since then, analysts have observed a shift, not necessarily illegal, but strategic, more physical, less paper, more long-term positioning. And here's the hard truth. If major financial players are accumulating metal while public narratives claim it's stagnant, someone is early and someone is late. Only time will reveal who. So, why does a $10 gap matter? Because it suggests two realities forming at once. One price for public markets, one for those closer to the supply chain. It's like a storm forming far offshore. You don't see the wave on your beach yet, but ships at sea are already rising. Smart captains adjust before they hit land. The rest, they get wrecked. Now, let's talk industrial panic. Investors feel FOMO, fear of missing out. Corporations feel FODU, fear of disruption and uncertainty. That's more powerful. If a vehicle manufacturer needs silver to finish cars, and the value of each car is tens of thousands of dollars, paying $100 instead of $80 for silver is irrelevant. It's survival math. $500 per ounce might still be cheaper than shutting down a factory line. That's the logic that sent rhodium to nearly $30,000 an ounce during the auto emissions crisis. Not hype, necessity. This is not a prediction that silver goes to 100, 200, or any number. No one knows the future. Markets move in ways that make fools of the confident. Prices can fall. Surprises happen. Governments intervene. But what is clear today is this. The world we knew, abundant cheap silver, unlimited global flow, endless vaults, is fading. A new phase is unfolding, not because the internet says so, because the supply chain itself is changing shape. If silver becomes harder to source and volatility increases, refineries may hesitate to hedge. If hedges become expensive, production slows. If production slows, scarcity grows. It becomes a feedback loop. The higher the price goes, the harder it becomes to create more supply. Not logically, but practically. And markets care about reality more than logic. Let's zoom out. This is not just about silver, it's about the economic architecture of the next century. Decarbonization, electrification, digitalization, whatever label you prefer, all require resources. Real resources, minerals, metals, materials, energy. If gold is a mirror that reflects fear in financial systems, silver might be a mirror for technological transformation. If gold protects capital, silver could power progress. And now we arrive at the crossroads. One path is status quo. Prices stabilize, supply adapts, the world adjusts. Silver sits between $50 and $100, volatile but manageable. The other path is structural shift. Policy plus demand plus scarcity equals repricing. Not overnight, not linearly, but relentlessly. A stairway, not a rocket. What happens will not be decided on YouTube or Reddit or Twitter. It will be decided inside trade agreements, commodity exchanges, manufacturing plants, and government ministries. It will be decided by storms we can't see yet, but we can feel the wind. Before we end, let's anchor the message. No fear, no hype, just clarity. Silver is not guaranteed to go higher. Silver is not guaranteed to protect you. Silver is not guaranteed to solve the future. But silver is undeniably more important to the world economy than most people realize. And when reality and perception collide, markets wake up fast. If this breakdown helped you understand the stakes, tap subscribe right now. Because the next 48 hours, the first quarter of 2026, and the decisions made this year could reshape the metals world. And we'll track it step by step. Now I want to know what you think. Does silver remain a humble metal? Or does it graduate into strategic resource territory? Drop your prediction below. Because history is happening in real time, and we are all witnesses to the rewiring of the world.